Here is something that surprises most people. 82% of business failures are caused by cash flow problems. Not by bad products, not by lack of customers, not by poor profit margins. Cash flow. And the shocking part, many of these businesses were profitable right up until they collapsed. Today we're going to understand exactly why that happens, and how to spot it before it is too late. Profit and cash flow measure completely different things. Profit is revenue minus expenses. It is an accounting concept, a number on a spreadsheet that tells you whether the business model is working. Cash flow is the actual money moving in and out of your bank account. It is real. It is what you use to pay your staff, your suppliers, and your rent. Here is the crucial insight. A business can be profitable on paper while having zero cash in the bank. The most common reason: timing. Imagine you run a business. In January you make a big sale, $50,000 worth of goods or services. You raise an invoice. Your accountant records it as revenue, but your customer has 90-day payment terms. They won't pay until April. Meanwhile, your suppliers want paying now. Your staff get paid this month. Your rent is due. Your utilities are due. You have a perfectly profitable month on paper, but your bank account is running on empty. This gap between when you earn money and when you actually receive it is where businesses die. When you look at a company's cash flow statement, you'll see three sections. Operating cash flow. This is the cash generated by the day-to-day business, selling products and services. This is the most important number. A healthy business should consistently generate positive operating cash flow. Investing cash flow. This covers buying or selling long-term assets, equipment, property, acquisitions. This is often negative for growing companies, and that is not automatically a bad thing. Financing cash flow. This covers borrowing or repaying money, issuing shares, or paying dividends. It tells you how the business is funding itself. Healthy operating cash flow is the foundation. Everything else builds on top of it. Let me show you how this plays out with a hypothetical restaurant chain. Their income statement looks fantastic. $2 million in revenue. Costs of $1,550,000. Net profit of $250,000. The owners are celebrating. But look at the cash flow statement. Customers paid slowly. Cash from sales was only $1.4 million. Suppliers required upfront payment. That is $700,000 out immediately. Staff payroll was $800,000. Rent was $200,000. And they bought new kitchen equipment for $500,000. Net cash position, negative $800,000. Profitable. Broke. Both at the same time. Here are 5 warning signs to look for in any business, whether you are investing, lending, or running one yourself. 1. Profit growing but cash declining. This is a classic accounts receivable problem. Customers are buying but not paying fast enough. 2. Negative operating cash flow. The core business isn't generating real cash. If this persists across multiple quarters, it is serious. 3. Financing cash flow exceeds operating cash flow. The company is relying on loans or investors to fund its daily operations. This is unsustainable. 4. A large gap between net income and cash flow from operations. Significant differences here often signal aggressive accounting worth investigating. 5. Shrinking cash reserves quarter over quarter. The runway is shortening. This is often the last warning sign before a crisis. Smart businesses don't wait for cash flow problems to appear. They manage proactively, invoice early and follow up fast. Don't wait 90 days to get paid. Send invoices immediately and chase them at 30, 60, and 90 days. Negotiate supplier terms. Push your payment terms to 60 or 90 days where possible. This buys you breathing room. Keep a cash reserve. 3 to 6 months of operating expenses in reserve is the standard. Never let this run dry. Use a rolling cash forecast. Project your cash in and out 13 weeks ahead. Surprises kill businesses. Forecasts prevent them. And always review both your profit and loss statement and your cash flow statement every month. They tell different parts of the same story. 4 things to remember. 1. Profit does not equal cash. They measure different things. Profit is an accounting concept. Cash is reality. You can't pay your staff with profit. 2. Timing is everything. A 90-day gap between invoice and payment can sink an otherwise healthy business. Always know when your cash is actually arriving. 3. Watch operating cash flow. This is the number that really tells you whether a business is genuinely healthy, not the headline profit figure. 4. Always read both statements. The income statement and the cash flow statement together tell the full story. Reading only one is like navigating with half a map. Next time you look at a business, whether you are investing in it, working for it, or running it, don't just check the profit. Check the cash. That is where the truth lives. If this video was useful, please hit like and subscribe. New finance videos every Monday, Wednesday, and Friday. Friday, we're tackling how to value a stock using the price-to-earnings ratio, with real company examples and a practical step-by-step process you can use immediately. See you then.